There is a negative prognosis despite the fact that there is currently solid demand and higher prices. Citi forecasts that oil prices would collapse to the range of $60 by the year 2025 as a result of the accumulation of stockpiles following a tight market this summer. Since the beginning of June, when the OPEC Plus group indicated that it could begin restoring some supply to the market in the fourth quarter, the market has recovered from the losses that it experienced. Bearish signals have been issued throughout the market. While the international benchmark, Brent Crude, was trading at more over $85 per barrel early on Friday morning, the benchmark for the United States, WTI Crude, was trading at more than $82 per barrel. This occurred as indications of tightening physical markets began to appear. Additionally, the market is concerned that the quarterly consumption increase will begin to slow down in the fourth quarter, which would put downward pressure on oil prices. The market anticipates that summer demand will be strong in the third quarter. Citi, which is one of the most prominent bears among big banks, anticipates that oil prices will fall into the area of $70 later this year and further down to the range of $60 in 2025 as a result of solid inventory buildup. Global inventories will be building up a lot next year, Eric Lee, the global energy strategist for Citi, said in an interview with Yahoo Finance this week. We do think that there is a bit of a tight stretch with supply through the summer, so we do see prices staying in the low to mid-80s for a little longer, the strategist stated. But as we're looking through the second half of the year into 2025, we really see markets getting a lot weightier. According to Lee, who spoke with Yahoo Finance, oil demand can grow at a slower and slower rate relative to GDP and in fact peak before the end of this decade. Citi likewise anticipates a slowdown in the growth of the world's oil demand. Regarding oil pricing and demand, Citi has some of the most pessimistic short and long-term projections. For instance, Goldman Sachs stated this week in a research that peak oil demand is still a decade away. The International Energy Agency predicted earlier this month that the world's oil consumption would peak before 2030. The IEA's prediction is a dangerous commentary, especially for consumers, and will only lead to energy volatility on a potentially unprecedented scale, according to OPEC Secretary General Haytham Al-Ghais, who also stated that peak oil demand is not on the horizon. While some prominent forecasters have predicted oil demand will peak by 2030, our researchers expect oil usage to increase through 2034, stated Goldman's analysts. According to Nikhil Bhandari, co-head of Asia-Pacific Natural Resources and Clean Energy Research, and analyst Amber Kai, we think peak demand is another decade away, and more importantly, after the decade it takes to peak, it plateaus, rather than sharply declines, for another few years, as stated in the team's report. According to Goldman Sachs, Brent Crude will likely reach $86 a barrel this summer due to robust consumer demand, which would result in a significant deficit for the market in the third quarter. The physical demand for petroleum, which tends to increase at weaker prices, especially in China and the US for the replenishment of the Strategic Petroleum Reserve, SPR, is another reason why the investment bank forecasts a floor of $75 per barrel under Brent. The majority of banks predict that oil prices will remain above $80 per barrel this summer before falling into the $70 in the fourth quarter and early next year. JP Morgan projects that oil prices will average $75 per barrel in the upcoming year, down from last summer's predicted range of $80 to $90. While interest rate and global economic growth trends will be closely watched by commodity analysts for their estimates later this year, they will also be intently observing OPEC Plus's next move. The cartel and its non-OPEC allies, led by Russia, are unlikely to leave oil prices hovering around the low $70 and dropping to the $60 because none of the alliance's producers can balance their budgets at these comparatively low prices, even though the group has indicated a willingness to start unwinding some of the current supply cuts. Following the U.S. Energy Information Administration's estimate of a 2.5 million barrel drop in inventory for the week ending June 14, crude oil prices increased little today. The shift was made in comparison to the 2.7 million barrel inventory rise from the previous week, which put pressure on prices. The Energy Information Administration projected inventory draws in the fuels sector for the week ending June 14. The week ending June 14 saw a 2.3 million barrel decline in gasoline inventories, indicating a robust start to the summer driving season and likely impacting the mood of the oil market. The difference in inventories from the prior build of 2.6 million barrels. The average daily production of gasoline last week was 10.2 million barrels, down from 10.1 million barrels the week before. The authority projected a 1.7 million barrel drop in middle distillate inventories for the week ending June 14. This is in contrast to the 900,000 barrel build from the prior week. Last week's middle distillate output averaged 4.8 million barrels per day, down from the previous week's 5 million barrels per day. Meanwhile, oil has been rising this week following the most recent drone attack by the Ukrainians on a Russian terminal, which resulted in a fire, and Israel's foreign minister declaring that the country was getting closer to going to war with Hezbollah. Brent Crude increased slightly beyond $85 per barrel as a result of this geopolitical premium, while West Texas Intermediate was trading above $82 per barrel at the time of this recording. Lower rates are expected to increase demand for commodities, especially oil, therefore expectations of rate reduction in the US also push the scales in favor of higher prices. These expectations were further reinforced earlier today by indications that the US labor market is cooling, as seen by a decrease in the most recent weekly report on jobless claims. We should be seeing signs of a tightening in the physical market, ING analysts Warren Patterson and Eva Manthe said in a note on Wednesday. Our balance shows the market tightening in the third quarter of this year after the rollover of OPEC plus cuts. But the performance of demand determines how tight it gets. The market is still concerned about weak refinery margins, they said. Amidst mounting tensions between Israel and Lebanon, which are on the verge of a full-scale conflict, Brent Crude and the US benchmark West Texas Intermediate found stability again on Thursday. This was also helped by employment data that showed a decline in first-time unemployment claims last week, even though all signs point to a cooling US labor market. Thursday saw Brent reach a 7-week high, up 0.62% at $85.60, as increased optimism about a rate decrease later this year was bolstered by this week's jobs report. At $81.15, WTI, the US standard, was up 0.71%, or 58 cents, for the day. The Federal Reserve kept interest rates constant last week, signaling that there will be one reduction in 2024 and several reductions the following year and beyond. The strongest evidence yet that inflation is dropping came from fresh inflation data that revealed a noticeable reduction in consumer price increases for May, just before the Fed's announcement. The Bank of England, BOE, declared on Thursday that it would maintain its benchmark interest rate at 5.25%, which is a 16-year high. The BOE met for the final time before the July 4 UK elections. According to Reuters, BOE Governor Andrew Bailey stated, "We need to be sure that inflation will stay low, which is why we've decided to hold rates at 5.25% for now." Bailey was hailed as providing good news. In the midst of the contentious discussion about the world's oil demand earlier this week, Rystad Energy predicted that the extension of OPEC plus voluntary cuts and the cartel's demand projection would cause the increase of the world's oil supply to decelerate in 2024 and maybe the year after. According to the most recent OPEC plus projections, the rise in the world's oil production is expected to be almost zero in 2024, making this year the first without supply growth since 2020, according to Rystad.